Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Monday, everybody. I hope you've had a restful weekend, and I wish you all a productive week ahead. Today's episode will contain a sponsored feature. The sponsored feature will be labeled throughout and can easily be skipped using the chapter feature below. This channel incorporates 2 to 3 sponsored features per month to ensure that it is financially sustainable. If you'd like to know how I work with sponsors, this is in the description below. Now let's jump into today's episode, which will be focused on the Chinese economy and specifically trade. Over the weekend saw the publication of customs data for the month of May. According to these official numbers, which are relatively reliable as they can be verified with trade partners, China's exports in May grew faster than expected. Exports rose by 7.6% in May from a year ago in US dollar terms, beating expectations for 6% growth. Imports rose by just 1.8% during that time, missing forecasts of 4.2% growth, once again demonstrating just how weak Chinese demand is. Indeed, Chinese exports rose in May at the quickest pace in more than a year, as China rapidly builds up new factories and expands existing ones as part of its national strategy. Weak domestic demand has encouraged many Chinese producers to look abroad for markets, including in industries like steel and building equipment that lost customers at home when the housing bubble burst and construction stalled. Beijing is relying on sales abroad to offset weak consumer spending at home. These numbers indicate that the strategy is paying off so far this year. However, it will likely exacerbate existing trade tensions with many partners around the world, especially with the Europeans, a space we've covered over the weekend and which we will supplement later in today's video. In high-technology industries like electric vehicles especially, economies are erecting trade barriers. For now, Chinese exporters are continuing to front-load shipments or reroute exports via a third country to avoid tariffs. And these are not just in advanced economies either. Over the weekend, we learned that Turkey will raise tariffs on all vehicle purchases from China by 40%. The decision will be effective within the month. The EU is expected to notify China too that it will impose tariffs on electric vehicle imports this week. A formal pre-disclosure of tariffs could happen as early as Wednesday. We will be following this closely when it happens too. China's crude oil imports were little changed in the first 5 months of the year versus the same period in 2023. The country is the world's largest importer of crude. China's imports and exports to the US and the EU fell in May, but trade with the Association of Southeast Asian Nations rose, with China's exports to the region up by 4.1% year-on-year in the January through May period. Meanwhile, China's imports from Russia rose 7.5%. Last week, in state-run financial media outlet The Economic Observer, famous Tsinghua University economist Li Daokui recently argued that China's exports will continue to grow in the short term, but as the United States and Europe become more reluctant to importing Chinese products, China must turn to Southeast Asia. He cites Singapore as an alternative. This argument has raised some eyebrows, however. Quote, Singapore is unlikely to be absorber either of China's weak domestic demand or of Beijing's need to expand its share of global manufacturing. Singapore, after all, also suffers from relatively weak domestic demand, running trade surpluses of roughly 20% of its GDP, and with manufacturing comprising 21% of its GDP. It, too, relies very heavily on manufacturing for growth. The global average is 16%. The point is that trade imbalances can only be understood systemically. And the fact is, surplus economies cannot resolve their surpluses with each other. They can only run surpluses if there are an equal amount of deficit economies, and if the largest deficit economies take steps to contract those deficits, rather than manage their trade surpluses through trade with each other. Surplus economies will be forced to compete much more aggressively with each other. End quote. Meanwhile, Beijing appears to be preparing countermeasures to EU protectionist moves, as the two massive trade blocs get further sucked into a full-blown trade war. That is the big story of this week, and what we're going to discuss next. But first we move to the sponsored feature. I appreciate that some viewers will not be interested in this at all, but I do think it is an interesting opportunity and worth a sponsored feature. One of the most interesting and controversial developments in finance in recent years has been the rise of digital assets. Whether one sees the asset class as a lucrative new frontier, or view it currently as too unstable, a crowded, untested space with too many scams and non-starter companies, like technology stocks in the 1990s, Most do agree that digital assets are here to stay, and that among all these players are future Amazons and Apples. What is even more interesting is that the digital asset space is growing twice as fast than the internet did in the 1990s. Many traditional investors are increasingly interested in having some exposure to digital assets in the higher risk, high return part of their portfolio. However, they want to do so through holding traditional stock assets, rather than dealing with holding digital assets themselves. There is also demand for a diversified holding of these assets. Today's video sponsor, DeFi Technologies, DEFTF, provides an attractive way for investors to do just that. DeFi Technologies is a financial technology company that allows traditional investors to gain exposure to a diversified portfolio of digital assets across the decentralized finance and Web3 sector. The company manages digital asset exchange-traded products, ETPs, via its wholly owned subsidiary, Valor Asset Management. Taking equity in DeFi Technologies therefore enables traditional investors to gain access to a highly potent and rapidly expanding digital assets sector, including decentralized finance, through traditional stock ownership in a diversified fashion. But what is perhaps most exciting about the company at the moment is the potential for robust gains. The company is profitable, growing, and very undervalued, with brand recognition and a competitive advantage that is durable, and the market is starting to catch on. It's no wonder that DeFi Technologies stock value is up over 1,200% year on year. The jewel in the crown is the wholly owned subsidiary, Valor, which creates ETF-style products and issues them. It's set to have $1 billion Canadian under management and is making about 7.2% yield on its AUM. This yield is growing as the AUM increases. Is the company still undervalued? Well, digital asset heavyweight commentator Anthony Pompliano told Bloomberg that, quote, "Regardless of how you cut the numbers, I still believe that DeFi Technology is undervalued. Given this additional information in the latest earnings report, I believe DeFi Technologies has a good chance of being one of the best performers from any stock that was pitched at the Zone conference in April," end quote. He added, quote, "I am not merely sharing my opinion though. I am a shareholder of DeFi Technologies that will benefit if the market figures out the company is undervalued, and I will be financially punished if the company ends up not performing how I believe it will," end quote. Other analysts are very bullish too. In this report that was just published on the 30th of April, analyst Michael Kim, using a conservative discounted cash flow model, gives DeFi Technologies a fair value of $3 compared to its current quote of around 96 cents. And this report came out before the company released their earnings report a couple of weeks ago, when the company saw record operating revenues and net income, recording its strongest quarter ever. DeFi Technologies is a very exciting opportunity for traditional investors to get exposure to this explosive emerging asset class, and, as such, is worth consideration for inclusion in any well-diversified portfolio. Some risk, but potentially high rewards too. We remember that all investment involves risk. This is not individual investment advice. Always speak to an investment professional before making any investment decision. A big thank you to DeFi Technologies for sponsoring this episode of China Update. Okay, now let's move back into regular coverage. Over the weekend, state media reported that Chinese companies plan to ask authorities to open an anti-subsidy investigation into imports of some dairy products from the European Union. The EU exported 1.7 billion euros, $1.84 billion in dairy products to China in 2023, down from $2 billion in 2022. As regular viewers know, Brussels has launched probes investigating Chinese government subsidies for manufacturing. There is more than a dozen inquiries being conducted by the EU into Chinese state aid, including an investigation into exports of solar panels, heat pumps and wind turbines, which the energy sector says are undercutting the EU by 50%. Companies can obviously see the writing on the wall as well. Investment by Chinese firms into Europe fell to the lowest in more than a decade last year, with most of the new money going into electric vehicles and related industries. According to a new report from Rodian Group and the Mercator Institute for China Studies in Germany, Chinese companies invested 6.8 billion euros, $7.4 billion into the 27 European Union countries and the UK in 2023. That was the lowest since 2010. The report explains that almost 70% of the new money went into EV-related areas such as batteries. Hungary received 3 billion euros of new Chinese investment last year, 44% of the total that went into Europe. We remember from our coverage earlier this year of Xi's trip to Hungary that the country represents one of China's closest partners in the EU, and as such has benefited from many carrots in China's carrot-stick approach to the union. The Rhodium report also did find that healthcare, consumer and ICT sectors remain relatively resilient, though. The report also found that the value of mergers and acquisitions fell by 58% to just 1.5 billion euros. Quote, China's economic difficulties and strict capital controls alongside increased scrutiny of foreign investment into Europe contributed to the fall in M&A deals, end quote. The report concludes that there is no significant recovery in sight. Quote, the drop in Chinese investment in Europe will continue to be cushioned by ongoing investment in the EV sector, but a substantial uptick is not expected. Instead, investment is likely to remain at low levels due to the weak financial positions of Chinese firms and increased government oversight in Europe. Chinese firms must also weigh up market opportunities in Europe against the backdrop of growing EU-China trade tensions, end quote. And the feelings go both ways. Yesterday, UK-based The Financial Times, citing unnamed executives, reports that European buyers are seeking to reduce their dependence on China, quote, as Brussels increases scrutiny of goods from the world's largest export economy, end quote. Richard Lubb, chief executive of Belgium-based Dragon Sourcing, told the outlet, quote, the big trend right now is for companies to reduce their dependence on China, end quote, adding that while the US had taken the lead in decoupling, European countries stepped up efforts to look for alternatives since the end of the pandemic. Quote, what I'm seeing now is the EU catching up on that trend as well, end quote. He explains that European customers were increasingly concerned about their exposure to China, especially those in non-food retail industries, estimating that the country accounted for 80 to 90% of sourcing spend for some of the continent's largest groups, expressing, quote, non-food is very, very dependent on China. Those types of companies in Europe are pushing hard to look for alternatives, end quote. Last month, in a conversation with reporters, William Fung, deputy chair of Fung Group, which controls Li & Fung, one of the world's largest sourcing groups by revenue, explained, quote, a lot of the European countries, may not have any problem working with China, but they think that if China is going to be impacted, okay, they'd better also think about how it's going to affect them. As a result, there will be more diversification away from China. Even though China may be the most optimal place, you can't afford to be optimal and wrong. Customers are saying that, I don't care what you do, William, just get me to 30% outside of China, and sometimes even more. Some have even said that they want to be completely out of China. Many of the buyers feel a risk in procuring from China. So if the price has a little bit of room, they prefer to go to India. End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Monday, and I will see you all tomorrow.